Will 2026 really be the year you get rich or wiped out? Tom Nash says yes. Let's see how much of that holds up when you actually look at the numbers. Welcome back to the comment section with Thomas Paul. Tom Nash just dropped a video called "A Once-in-a-Lifetime Event is Coming in 2026," and he's basically saying 2026 is going to be like nothing you've ever seen, unless you were alive for every other time people said that. In his version, smart investors get rich, everyone else ends up in the poorhouse, and the S&P 500 does a euphoric 25 to 30% blow-off move into 2026 before the cycle dies. Today, we're going to fact-check that, not to dunk on Tom. He's thoughtful, and he lays out an actual framework, but to separate interesting scenario from "I'm going to remortgage my house because a YouTuber said 8,500. First, let's set the stage. Picture the S&P 500 from the October 2022 low to today. That low was around 3,500 after the Fed went full, "We're not kidding about inflation." Since then, we've ripped higher. As I'm recording this, we're roughly in the 6,700 to 6,800 neighborhood, depending on the day you look at. That's about a 90% gain from that bottom over roughly 3 years. Tom's framing is, hey, the index almost doubled in 3 years. That's triple the usual 10% a year. We've got AI, we've got coming Fed cuts, and he thinks 2026 could tack on another 25 to 30% blow-off on top of that. That's the core claim we're going to stress test. So let's start with the "we're already way ahead of normal" piece. Tom basically says, since the October 2022 low, the S&P is up roughly 90% in 3 years, which is like triple the historic 10% a year. That part is actually pretty close to reality. Long run, if you look at data from places like Ibbotson, Morningstar, and the S&P Dow Jones folks, U.S. stocks have done around 9 to 10% a year, including dividends over many decades. Now, if you go from that October 2022 low near 3,500 to around 6,700 to 6,800 today, that's about a 90% total return, which works out to something like 25 to 28% annualized over that window. That is spicy. But here's the key. This is not some unheard-of miracle. We've had runs like this before, multiple times. In the 80s, coming out of the brutal early 80s recession and Volcker's rate hikes, the S&P had a monster stretch, over 20% annualized for several years in the mid-80s. In the 90s, especially from about 95 to 99, you had string after string of 20+% years. And more recently, from around 2012 to 2017, the index put in multiple double-digit years stacked together after the great financial crisis. And did each of those runs end exactly when the 3-year annualized number got too far above 10%? No. Sometimes markets kept going for years. Sometimes they gave back a chunk. The point isn't that above average is rare. The point is it tells you very little about when the music stops. So on this one, verdict. Directionally fair. The S&P has absolutely outpaced its long-run average since October 2022. That doesn't automatically mean a crash is imminent, and Tom does admit that. Long, hot streaks happen and have happened over and over. Using "we've had a good 3-year run" as your timing tool is like using the odometer to predict exactly when the engine will blow. You know it will wear out eventually, but not at mile 72,413 on the dot. Now let's get into his big driver. AI plus Fed cuts equal a 25 to 30% jump in 2026. Tom's story goes like this. AI infrastructure spending is exploding. Hyperscalers and chip makers are throwing hundreds of billions of dollars at data centers and GPUs. And at the same time, the Fed is likely to be cutting rates into 2025 and 2026. That combo supposedly creates a flood of money that pushes earnings higher, keeps valuations high, and drives this monster 25 to 30% S&P year in 2026. So, what do we actually know here? On the AI side, the spending is very real. NVIDIA talks about data center demand going vertical. Microsoft, Amazon, Google, Meta, they've all guided to absolutely huge CapEx numbers. Some Wall Street estimates have global AI-related CapEx running at hundreds of billions per year over the next few years. If you look at earnings calls and filings, these are not fantasy numbers. Companies are literally breaking out AI-related spending in their plans. So yes, AI infrastructure is a genuine growth driver, especially for a small number of mega-cap names that now dominate the S&P 500. Same story with earnings expectations. Consensus analyst forecasts. If you look at FactSet, Bloomberg, or S&P data still call for healthy earnings growth into 2025 and 2026, aided by AI, productivity, and a less hostile Fed. On the Fed side, if you look at the Fed's dot plot, the little chart showing where each policymaker thinks rates will be, the median dot as of late 2024 and early 2025 has rates drifting lower into 2025 and 2026. Futures markets have also priced in several cuts over that period, especially compared to the peak in 2023. So Tom is not inventing those forces. AI capex is huge. The Fed does expect easier policy than 2023. Earnings expectations are positive. But here's where we leave data and enter storytelling. First, markets repeatedly mispriced the exact path of Fed cuts. Go back and check. In 2019, 2020, 2022, 2023, futures and strategists almost never got the timing and magnitude right. Same with earnings. Analysts nearly always extrapolate recent trends, then reality wanders off in its own direction. Second, the translation from AI spending and lower rates to exactly 25 to 30% index gain in 2026 is not something you can model with any confidence. That number is an educated guess, not a law of physics. Historically, the S&P has had big years, 25% plus returns, maybe one out of every 4 or 5 years, depending on the exact sample. They happen, but they're not the base case every time someone builds a new kind of server rack. So my verdict here, the underlying forces Tom highlights are real and important. AI capex is enormous, and it's very plausible that rates in 2026 are lower than the peak in 2023. But drawing a straight line from that to therefore 25 to 30% in 2026 is speculation. It's a coherent scenario, not a fact you can plan your leverage around. Let's move to his small cap point because that's where it gets spicy for people looking for alpha. Tom argues that small caps, think Russell 2000, are stuffed with variable rate debt. So when the Fed cuts, their interest burden supposedly collapses and their earnings explode, which then causes an absolute explosion in small cap performance and closes the gap with the S&P 500. There's a grain of truth here, but we need to be specific. If you look at breakdowns from places like FTSE Russell or some of the big banks that analyze the Russell 2000, smaller companies do tend to be more sensitive to credit conditions. They're less likely to issue long-term fixed-rate bonds and more likely to borrow via bank loans and credit lines, some of which are floating rate. They also generally start more indebted relative to their earnings and have thinner margins. So when rates spike, their interest expense eats a bigger slice of their profits. When rates fall, yes, that pressure can ease. But here's the catch. Not all that debt is floating. A decent chunk is still fixed. And a lot of the Russell 2000 right now is low quality, unprofitable, or in weaker sectors. If you look at aggregate Russell 2000 interest expense and profitability from data providers like S&P and Bloomberg, the story is not, we just need 100 basis points of cuts and suddenly we have a profit explosion. It's more like some highly leveraged names get relief, others are just structurally weak. Historically, small caps do tend to perform relatively well once the Fed is done hiking and starts cutting, especially coming out of recessions. There are studies from places like Fama French and various strategists that show small cap outperformance in early cycle periods. But we're not clearly in an early cycle recession recovery story right now. We're in a weird, late-ish cycle with decent growth and high margins, and small caps have lagged for a bunch of reasons. Quality, profitability, sector mix, not just interest rates. So I'd call Tom's claim half true. Yes, small caps are generally more rate sensitive, and if the Fed cuts, that's a tailwind. But the idea that rate cuts alone guarantee an absolute explosion and an automatic catch-up for the entire Russell 2000, that's overstated. Quality still matters. A basket of zombie companies doesn't magically become a goldmine because the Fed funds rate goes from 4% to 3%. You're probably thinking, okay, but what about the human side of this? Retail mania, leverage, people mortgaging their house to buy meme coins. Tom's next argument is classic bubble anatomy. As markets rip higher, more uninformed retail piles in, options and crypto go nuts, people take on extreme leverage, and that retail FOMO creates the late cycle euphoric spike. He paints a picture that looks a lot like 1999 or 2021. Let's see where we are right now. If you look at retail trading flows and options volumes from places like JP Morgan, Vanda Research, and brokerage stats, yes, retail involvement is back up from the post-2022 hangover. Zero-day options, single stock call volume, smaller account activity, it's not dead. But compare it to peak periods. In 2021, meme stocks like GameStop and AMC were trading like slot machines. Retail call option volumes were off the charts. Even regulators were writing reports about it. Today, we're elevated compared to, say, 2014, but we're not obviously at 2021 insanity. It's more enthusiastic than frothing over. Same with margin debt. FINRA's margin debt data shows that margin balances have been rising again with the market, but they're still below the absolute peaks we saw around the 2021 top, adjusted for market cap. So people are using leverage, but we're not at full YOLO refinance the house level in aggregate. And if you look at household equity allocation, the share of household financial assets in stocks, Fed and Fed-related data show we're high, but not necessarily beyond anything we've seen before. We're in elevated territory, similar to other late-cycle periods, but not clearly at a new world record. So Tom's mechanism is directionally right. That is how late-cycle bubbles typically play out. More participation, more speculative behavior, more leverage. But current data says we're not yet at 2000 or 2021 levels of frenzy. Could we get there by 2026? Absolutely. Does it have to happen on schedule because a model says so? No. Think of it this way. He's describing the classic script. The script is plausible, but the director, real-world investors, get to improvise. Now let's tackle the headline claim. Tom suggests it's very likely that 2026 gives you a 25 to 30% S&P year up to around 8,500, and that this is the euphoric blow-off and end of the cycle. He's not promising the exact month, but the year and level are his base case. First, how rare is a 25+% year? If you look at S&P 500 history, calendar year returns over 25% aren't unicorns, but they're not common either. Depending on your start date, they show up maybe 15 to 20% of the time, so something like 1 out of 5 years. We had big years in 2013, 2019, 2021, for example. They often cluster after drawdowns or early in expansions, but they can happen later too. The wrinkle here is, stacking a huge year on top of an already huge multi-year run is less common. It's not impossible, but historically, you start running into the gravity of valuations. Right now, broad valuations, things like price to earnings or Shiller CAPE, are elevated relative to long-term averages, though not quite at peak 2000.com levels. A lot of the S&P is concentrated in a few mega caps that are already richly valued. Could earnings plus AI plus lower rates justify 8,500? In some scenarios, yes. But here's where humility comes in. No one, including Fed officials, can reliably time the exact end of a cycle years in advance. If you read speeches from Fed chairs, IMF reports, or big bank strategists looking back at past cycles, the consistent theme is, we didn't see the exact timing of the turn. And if you scan Wall Street strategist targets for the S&P, Goldman, Morgan Stanley, JP Morgan, you name it, you'll see their 2025 and 2026 targets are all over the map. Some are more bullish, some are cautious, and they change them constantly. The range of outcomes is wide. So when any one person says it's very likely that 2026 is the 25 to 30% blow-off top to 8,500, just file that mentally under one possible story among many. Is it internally consistent? Yes. Is it a proven inevitability? No. My verdict. Tom's scenario is bold and thought through, and it could happen. But the precise level and timing are speculative. It should not be treated as base case fact, especially not as justification for leverage or binary bets. So if you're a normal investor watching this thinking, okay, then what am I supposed to do with all these 2026 super calls? This is where we zoom out. Here's what I think Tom gets absolutely right. Most investors underestimate how wild late cycle phases can get. Markets can get way more expensive, and sentiment can get way more euphoric than seems rational. And most people dramatically overestimate their ability to get out at the top. Every bubble has a chorus of, "I'll just sell before it crashes," people. Almost none of them actually do it cleanly. They're early and miss upside, or late and ride it down, or they bail at the bottom of the next downturn because they can't take the pain. The right takeaway from his video is not, "I need to guess 2026 levels." It's, "I need a system that works whether the blow-off is in 2026, 2027, or not at all." That means boring stuff. Diversification, so your future isn't tethered to one sector, one style, or one country. Position sizing. So even if AI small caps go parabolic and then crater, no single bet can nuke your net worth. Very importantly, not levering your portfolio against your house based on a YouTube forecast. Using home equity to punt stocks or crypto because someone on the internet said once in a lifetime is how you end up in the bad documentary, not the success story. And having a clear rebalancing plan. For example, if equities shoot way above your target allocation, say you plan to be 60% stocks and you drift to 75 or 80 because of gains, you systematically trim back. Not because you know the top is in, but because you're protecting against being overexposed when the inevitable drawdown hits. If valuations get extreme and your allocations drift way off your plan in 2025 or 2026, you don't need to call the exact top. You just follow your rules. That plan barely changes whether Tom's 2026 blowoff happens exactly as scripted, shows up a year later, is milder than he thinks, or never quite materializes. The discipline is the point. So, to circle back to the episode title, will 2026 be a 30% blow-off top for stocks? It might. It's one plausible outcome on the menu. We've had multi-year bull runs followed by a big, euphoric year before. We've got real tailwinds from AI spending and probably easier monetary policy than 2023. We've also got late-cycle risk, high valuations, and a retail investor base that is very capable of going full degen again. But treating any single YouTube forecast, Tom's, mine, anyone's, as destiny is dangerous. Use these predictions as scenario planning tools. Ask yourself, if there is a melt-up, how will I keep greed from wrecking my plan? If there's a grinding sideways market, can I stay patient? If there's a recessionary air pocket instead, am I over-levered or okay with a 30% drawdown? The future is not a script, it's a probability distribution. I'm curious where you land on this. Are you personally preparing for a 2026 melt-up, a boring grind, or a painful air pocket? Tell me in the comments what your actual strategy is. Not just your prediction, but what you're doing with your allocation and risk. If you found this breakdown helpful and you want more fact checks of big, dramatic market calls, especially the ones blowing up your recommended feed, hit subscribe, toss this a like so it reaches more nervous investors, and I'll see you in the next episode of the comment section with Thomas Paul.